Hi, my name's Greg Forstoffel. My blog is tecumsehbank.com. Today, what I'm going to do is analyze the financial statements to some extent of United Bancorp, take a look at what they did during 2009, try to forecast, try to understand what is going to happen for 2010, and then talk about some further analysis that will be needed down the line. This is the agenda, what I'm going to be talking about today, and I'm going to try to break this up into videos of not longer than 10 minutes. First thing we're going to do is review 2009. Then we're going to take a look at the income for last year and take a look at where I think the income is going to be for 2010. Then I want to talk about loan loss expense. Loan loss expense is really the factor that determines the profitability of the bank. And over the last couple years, as many people know, loan loss expense has been it's been horrendous. So I want to talk about that a bit. I think that'll take care of the first 10 minutes. The next video, then we're going to talk about the balance sheet, what those first two items, income analysis and forecast, and loan loss expense, is going to do for the balance sheet at the end of 2010. Then we're going to talk about capital requirements. The bank has said that it needs another $8 million in additional capital, and what will that mean to the balance sheet at the end of the year? And then finally, as I mentioned, future analysis will be needed, further analysis. For instance, how does this bank compare to other banks of its size? That kind of analysis is needed so we know whether we should really be critical of management or not. So now let's talk about what happened in 2009. First, I want to talk about the income statement, and what we see is basically with regard to interest income. Interest income is the primary source of bank income, not just for this bank, but for most other banks. And what the trend is, and has been for years, is to increase the non-interest income so that it sort of supplements and becomes a bigger piece, because non-interest income is more flexible. There are fewer restrictions. But looking at interest income here, what we see is that in 2008 compared to 2009 interest income was about $4 million less, $3.5 million less. And what we'll see going forward when we look at the balance sheet, we will see that the loans were down. The total loan portfolio was down about $50 million. So with fewer loan dollars out, you're going to make less interest. So that kind of explains why the interest income has deteriorated. On the interest expense side here, we can see that interest expense has gone down, and interest expense has gone down faster than the interest income has gone down, and that's good. And that typically happens in a decreasing interest rate environment. The interest expenses go down because the bank's able to cut pretty much immediately the interest that it pays out, but the interest income does not go down as fast because people have to refinance the loans that they get. So what we see is that net interest income actually went up about $2 million. Then here we have the big problem, provision for loan losses. We see in 2009 provision for loan losses was $25.7 million compared to the loan losses in 2008, which was $14.6 million. So a lot worse as far as writing off loans is concerned. And so that affected net income, the net interest income. Net interest income went down almost $10 million because of that. Now, as I was talking about before, let's take a look at the non-interest income. Non-interest income is basically service charges, And what we see is that the service charges went up in 2009 by about $3 million, and the majority of that came from loan sales and services. Uh, the bank probably ended up selling a lot of its loans and getting revenue from that. In addition, it is probably um, servicing a lot more loans than it used to in the past. So that has caused an increase in service income, what they call total non-interest income. The other reason the bank is interested in improving this number is because there's no capital requirements needed for this kind of income the way there is um, with interest-related income. I'll talk about that further. Now, quickly, let's look at non-interest expense. These are basically operating expenses, and the orange highlights are basically the main drivers uh, of the total non-interest expense, which we see was up by about 8 million this year. Salaries and benefits was up about $1.5 million. That was due apparently to the fact from the previous slide, loan sales and service. They probably contracted out a lot of that loan sales and service, and that is why there was that much income, but that came at a cost of an extra basically about another $1.5 million. Next thing we see is real estate owned expense. The bank is no doubt taking back a lot of real estate, and there is expense associated with maintaining that real estate. And what we can see is that that expense has gone up about $1 million. FDIC insurance has gone up $1.5 million. We can go expecting that with all the financial issues out there, financial system issues out there. The FDIC is going to be bailing out a lot of banks going forward. So semi-profitable banks like UBT is going to be going to be having to pay more for its FDIC insurance. Finally, goodwill impairment was up $3.5 million. What this is, sometime in the past, the bank bought some property from somebody, probably bought some branches or some facilities from somebody else and paid market value at the time, which ended up being about $3.5 million over what the book value was. So they booked that additional cost to goodwill. And last year, the market value came back into basically slipped back. So they got to write off the goodwill impairment, write off that goodwill, and to the expense of $3.5 million expense. So there's no more goodwill on their balance sheet. So there should be there will be no more goodwill impairment. That is basically what I want to go over as far as the income statement is concerned. And I'm going to stop this video here, and we'll go on next to the balance sheet and talk about loan loss expense. But this video is getting to be about 10 minutes, so I want to cut it off here. And I will see you at the next video.